Now let's talk retail, and shares in Europe's largest online retailer, Zalando, are falling after publishing a profit guidance for this year that missed some analyst expectations. Joining us now from Berlin is David Schroeder, the Chief Financial Officer at Zalando. David, delighted to have you with us on the show. Thank you so much for joining. Talk to me about the potential coronavirus impact that you're seeing on your business at the moment. How would you characterize and quantify it?
Good morning from Berlin. Thanks for having me on the show. So far, we haven't seen any material impact from the coronavirus on our business. Obviously, the situation is still evolving, and therefore we are closely monitoring what happens and also preparing for any type of scenario. I think it's important to point out, though, that we are in a better position than many other businesses in the industry with regards to supply. Most of the inventory that we need to have a successful spring-summer season is already at our warehouses. And with regards to demand, we are obviously far less dependent on physical footfall and offline stores than many other players, so people can also enjoy our offering from the safety of their home. And therefore we remain confident with our full year outlook and expect to continue on our strong growth trajectory with 20 to 25% GMV growth and also an increase in our adjusted EBIT of around 10% in the range of 225 million to 275 million euros.
Are you anticipating then, David, any increase in demand from people staying at home and spending at home online?
I think so far that would really be speculation. I think, as I said, we feel well prepared, and obviously we are happy to supply all those customers that want to shop with us. But I think it's too early to say whether it will present any type of sales opportunity for us.
What are you preparing for then as the potential biggest downside risk if, as you say, you're not as exposed to supply chain issues as some other retailers?
So I think with regards to the supply chain, we are mainly focusing our attention already on the fall-winter season. Although we are well covered for spring-summer, as I said, obviously we are closely working with our suppliers to make sure that the same is true for fall-winter. And since we're working with more than 2,500 brands sourcing from multiple countries across the globe, I think we'll also be able to make sure that we are well covered for fall-winter. In addition, we are obviously also making sure that we can continue to operate as planned in Europe. This is mainly the case for our logistics network, where we benefit from also a wide-ranging network with more than 10 sites across more than 5 countries. And this also allows us to react flexibly to any type of situation.
David, your profit guidance for this year missed some analyst expectations. Would you say that for the time being, Zalando is more focused on growth, increasing customers, gaining market share, rather than on profitability?
Our number one priority is definitely to drive strong above-market growth because we see that as key to drive up company value in the long term. This is something that we already outlined when we issued our new strategy last year. We said that we are going to continue to grow 20 to 25% over the next couple of years, and we are continue to invest into acquiring additional customers, into deepening customer relationships, and also in transitioning to a platform business model, because we think all these things will help us to triple the size of our business roughly when we compare it to where we were in 2018. So we target to grow to a size of 20 billion by 2023, 2024 in terms of GMV, which would imply a 5% market share of the overall fashion market for Zalando.
That said, you earlier did mention the EBIT margin, and I'm wondering whether in the long run you still want to lift that to 10 to 13%, and if so, do you have a timeline for when you might get there?
I think we provided a clear timeline when we communicated our long-term targets last year at the Capital Markets Day. We said that during the transition phase, so 2019 to 2021, we will actually have an EBIT margin in the range of 2 to 4%. That's what we achieved last year. That's what we are also going to achieve this year, and we are actually in the upper end of that range, both with last year's result and also with our outlook for this year. And then for the years after, we still target the margin to increase. And yes, our long-term target margin aspiration is still 10 to 13%.
Talk to me a little about the broader strategy as well in terms of adding more premium brands. How successful do you think you will be in taking on the likes of Yoox Net-a-Porter?
Well, let me first say that I think our key strategy is really to become the starting point for fashion and to offer consumers everything they want to look at and shop. And that obviously also includes premium and luxury fashion items. If we look back at last year, we were able to grow the premium category by 35%. It actually meant that this was the strongest growth of any category, and therefore we are also very confident that with new brands coming on and further improvements to our premium experience, we'll be able to drive further growth of our business and also to deepen relationships with our customers.